there are some distinct areas that we can actually take a bit of a look at. How does the technology potentially improve massively different areas of your businesses? How can you potentially use these digital assets? And how can we use the technology underneath to improve everyone's lives? And really from there, that's, diving a little bit into a little bit of a quick background that we can talk around the agenda. But I think Manny covered a lot of it. Why am I here today? Very quickly, I am one of the partners at Penrose Partners. We're a Canadian and Bermudian blockchain-focused consulting firm. So we do an awful lot of advising for both the Canadian and the Bermudian governments. We work heavily with startups within the space that are looking to use the technology in some way, shape, and form to build out a better solution. And we also do quite a lot of work in the investment space. So for many that are looking to get involved in digital assets, to buy Bitcoin, to hold it for generational wealth, we do also assist quite heavily in sourcing investment for these projects. And you can see some of the companies we've worked with down below. But really, what are we chatting about today? A couple major topics here. One, I am going to go a little bit into the history of money and how we got here. We'll talk around how that led to the emergence of Bitcoin itself. We'll discuss then how the technology of blockchain itself can actually then be applied, both from a fundamental perspective and then also looking at some of the functionalities. We'll talk a little bit around the growth of the space, everything we've seen from the rise of Ethereum, the different decentralized applications, and talk a little bit around the cryptocurrency market as a whole. And then finally, we've got a little bit of a special one put together for you guys to dive a little bit more into NFTs, which seems to be everyone's favorite topic of the day, and taking a look at where are the applications for these in particular. And then at that point, I'm happy to open it up to Q&A. There's obviously plenty of questions around how you guys could use this. There's obviously discussions around payments, around cybersecurity, and much more. But with that said, yes, please, Manny and team, if there's questions, please feel free to jump in and just let me know. Happy to kind of pause at the end of each section just to make sure there's anything that is cleared up. But with that said, we'll jump in quickly into a history of money. And don't worry, I swear I'm not going to spend a long time on this, but it's important to understand where we came from into understanding just how impactful that this technology can be. And really taking a step back to thousands of years ago, what really is money? And money, very simply, was introduced to solve what's known as the coincidence of wants. Very simply, if I have a goat and my neighbor has a bushel of wheat, well, if we're looking to trade, unfortunately, they need to want a goat and I need to want wheat. And if that doesn't actually happen, we are unable to actually engage in commerce. And this is where money came. Money fulfilled the three key functions that would solve this coincidence of wants. First and foremost, money in some way, shape, and form was a store of value. It meant that whatever we were using, be it gold, be it shells, or be it some other form of currency, it had to hold its value over time. This wasn't just something that was days or weeks, but it had to be years so that countries could build their treasuries and hold this for centuries. Secondly, I needed to have a money that was a medium of exchange, in that I'm able to take this across borders, I'm able to transact freely, I'm also able to have it to be divisible. And finally, the last piece of money really was this unit of account. I need to price things in it very simply. And so obviously as part of this comes in, everyone's thinking about the cash in their wallets. But if we actually think about it, gold has been the main facet of money for many centuries, if not millennia. And this is where communities and countries really came to the consensus that gold held these three key features in a way that was unbeatable for many years. So a couple of them really being, first and foremost, it's a scarce resource. It's difficult to create. The physical effort that actually goes into getting gold out of the ground was immense. You'd have teams of miners going into the ground. You'd have to go through and filter it. You'd have to then polish it up and then send it out to the market. It was an awfully difficult to create resource. It had to be mined out, and therefore, as part of this, it could never be wished out of thin air. It meant that there wasn't going to suddenly be a huge influx of supply. We knew roughly what was coming into the market rather than just unexpectedly seeing a large new influx. But secondly, it was easily divisible. We were able to break gold down into individual coins, into ingots, or even carrying around the gold bars that everyone sees in all of their favorite movies. And finally, the last part of money that really gold held up was that it was accepted by all. This shiny metal that was able to be traded around the world was held as a status symbol and was additionally able to expand commerce globally. But over time, this developed that we didn't just have money shifting into being carried around the globe, and unlike most of the past generations, none of us are really going to be carrying gold bars around in our day-to-day. And as part of this, we realized that in order for us to actually have a system that could make sense, we had to have another system that was built on top of the gold standard. And for us, this really led to us having central banks gather large amounts of the gold into their currency, into their vaults, and then issue out essentially IOUs, the currency that each of us do have in our wallets today and all around. And essentially, the way that this went was that a central bank would gather a large amount, keep it safe and securely, and issue out the amount that was therefore valued in respective to the gold that they held in their vaults. So it meant that now we're trusting in the central banks in order to actually be able to uphold this standard and ensure that we don't have a huge influx of the currency. But over time, this didn't happen. Once we hit around the 20th century, the central banks were realizing that they could just print as much money as they were looking to, and people didn't necessarily realize the influx that was happening in the years that were coming. It only became apparent much more after the fact. And as this over time, governments realized that this allowed them to actually print more money than existed in their vaults. And in turn, the effects of inflation were much more slowly seeping into society. But after World War II, it caught up to them. And this is where it became apparent that the money that was actually printed out and in circulation was far larger than it was that was actually held within the gold in vaults. And if we remember this, this is why gold was held as this idea of the creation of wealth. It took an awful lot of work to build it up. And so it wasn't something that could just be created out of thin air. And so as we then shifted away from the gold standard following World War II, this is where we've now had the system for the last 50 years of free floating exchange rates, meaning that we don't actually tie our currency back to the gold standard. We're not sitting around with large piles of cash that are tied and being able to be traded back for gold. And essentially, this led to our current financial system involving everything from fractional reserves to free credit, and has allowed for a lot of benefits along the way. But part of this is that, and I swear this is the only graph that will appear in this presentation, don't worry, this is where we start to actually be able to take a look at the impact that happened when we're diving into these individual systems and looking at how this is actually distorting a lot of the information that is actually out there. If we take a look at the graph over on the left, this is approximately the last 20 years of the S&P 500 priced in US dollars. Now, as you can see, we've gotten a nice little growth leading up prior to 2000. We hit the dot-com bubble and we came down from our first peak. We're then rising again up into the summer of 2008. And then as the subprime mortgage crisis hit, everything came back down. And over the last few years, we can see quite clearly that it looks like things are going quite well. But again, this is priced in the dollars within the system. And if we're actually taking a look at the value and the wealth that was created along the way, that is where we need to look at some sort of more scarce resource, like pricing it in gold. And this is where we have the graph on the right. This is the one where we can see that same rise originally up to the dot-com bubble, and then the resulting crash. But since then, that's where we've seen a lot of what has come to known as quantitative easing, and a lot more growth of the money supply has then led to this initial surge that we see over here, not necessarily being replicated within the system of actual wealth. And so when we hit 2008, we've still only been kept crashing down when we actually price this out in terms of actual wealth created. And then as we continue to rise up towards here, we see that as of 2020, and this is obviously pre-pandemic, we still never even rose up to the same level that the S&P was in the dot-com bubble. And so within this system is really where the distortion comes in terms of the dollars that were created themselves by governments around the world and by institutions that were using this as an advantage to gain more leverage in the system, didn't necessarily reflect the economy that was actually happening globally around the world. And so this is where within this system and within this context is where Bitcoin emerged. And Bitcoin itself has been bumping around the forums of the internet since around 2008. It has a long history of being able to be essentially built upon technologies over the last several decades. But Bitcoin itself emerged in around 2008 with the emergence of the original white paper. And if we take a bit of a moment to pause here and say, well, this isn't the first time that people have tried to build their internet money. It's not. In the 90s, we've had everything from DigiCash, we've had eGold, we've had eCash, and each of these were able to, in some way, shape, or form, create a digital repository that was able to then say, okay, what if we kept all of this money digitized? What if we were able to have some way of transferring value around the world without necessarily relying on a central intermediary. But the problem with this was that we still needed to have someone that was keeping track of who had what money. And one of the issues with the internet, of course, is that you're able to easily replicate things. And this is where we came to have what's called the digital double spend problem. If I, for example, have $10 in my wallet and I'm physically meeting up with Manny and I give him the $10, that transaction is therefore going to physically be recorded as that Manny now has that $10. But if instead Manny and I are then trading money across the internet, well, there's a little bit of a disconnect here. And that's what I mean by, if we're now sending Manny the money across the internet, how is it that I'm not able to then potentially copy that money and send it to someone else without telling Manny? All of a sudden, we have a situation in which we're now actually going to have potentially digital copies of the same dollars that are now out there. And so this is what became known, that if we're unable to track who has the money itself, it's very easy for people to double spend it. And in this context, this is what Bitcoin was able to solve. Bitcoin uses a variety of technologies baked into their system, but essentially built upon what we all know as blockchain. And Bitcoin itself emerged, as you can see here in the original white paper on the left, as a peer-to-peer electronic cash system. The idea being that instead of us relying on a central intermediary, we're going to actually have a peer-to-peer system that can rely upon itself to prove that we're able to have internet money free from the control of a central intermediary. And in 2008 was when the white paper came out, and the creation of Bitcoin itself actually came into life as of early 2009. And as we can see here, on the right is actually a message that was encoded into the original code of the Bitcoin blockchain. And it said, the Times 03, January 2009, Chancellor on the brink of a second bailout for banks. And so this is a little bit of a potentially tongue-in-cheek comparison that the creator of Bitcoin, Satoshi Nakamoto, who is, as of now, entirely anonymous. We don't know if it's a person. We don't know if it's a team. We're not certain who was the actual creator. This message on the right was actually encoded into the original system, which then actually was kind of saying, this is a solution. This is a way out of the current system. We've seen that there are multiple bailouts that are given to the banks after they go and misspend people's money, and it's the populace that suffers as a result of their mismanagement. But essentially, from here is where, if we were taking a look at, what is it that Bitcoin is actually able to do? Well, this is where we actually have a trustless network of value transfer. Unlike our central intermediaries nowadays, the banks that we all use for our day-to-day lives, we're relying on them to be trusted factors. We're relying on them to have the trust within the system and to believe that the bank is not going to screw me over when I send a transaction online. But Bitcoin turns this on its head. They're saying that we don't need to have trusted parties. We need to have a trustless system. And in this case, we're actually able to rely on the network to self-regulate and validate everyone's transactions. I will talk about this in a second in terms of the actual applications of blockchain and how it comes to be with respect to getting everything up and running. But really, this is where the debate around what exactly Bitcoin could be for the future does take an interesting turn. On the one hand, there's people that see it as a way for having this currency for payments. As we've covered, it does in fact fit several of the facets for why gold is so useful. It's highly divisible, meaning that you're able to break one Bitcoin down to what's called the smallest unit of a Satoshi. Obviously, a shout out to the creator himself or herself or themselves. And here is where being able to divide this down means that you don't need to necessarily have a full Bitcoin to trade with it. We can have an internet money that's broken down to 8 decimal places. It's highly exchangeable in that I could send money right now from my phone here and send some Bitcoin to Manny. But it also, on the other side, is held up as a store of value. There's a finite supply. And by looking at the code, we know that there will only ever be 21 million Bitcoin. So when we think back to the original reason of why could this potentially make sense as a store of value, well, Bitcoin now is able to have what would be known as a high stock to flow, meaning that the existing supply that exists is much larger compared to the incoming flow of the system. There's no surprise shocks like we've seen with the money printer going with Jerome Powell and much of the Federal Reserve. But we've also been able to have a system where Bitcoin is difficult to mine. It takes an awful lot of computing power in order to secure the network and in order to validate these transactions. I will cover this in a second as to how this comes together. But essentially, if we look at the middle, we can all agree that by having this, it's a decentralized system around the world that doesn't need to have any bank involved or any government. It's fully portable in that I can have it on my phone, on my computer, or even just in one of the hardware wallets that we can discuss. And it's globally accepted. You might not all be accepting Bitcoin today, but we have a pretty safe bet that in a few years, it'll be able to be globally accepted around the world. And really, part of this is just to say that, in this new age of value sharing that we saw, the rise of Bitcoin as this disruptive model and the regulatory changes that we've seen, this all essentially mirrors much of what was grown up in the 90s with the development of Napster, with the file sharing, and with a lot of the peer-to-peer networks that were around there. But this time around, we're actually going to create money on the internet and have a native currency for the digital world. And so I'll pause for a quick second there, but we're going to talk a little bit now around what is the actual technology underneath this and how is it able to create a lot of this value? But additionally, how is it able to be kept secure? But Manny and team, if there's anything in the chat, did you want to?
We do have one question discussing, the Satoshi Nakamoto and whether or not they think somebody's ever going to come up and, reveal who this is. And if that does, would that have an effect on the value of Bitcoin?
That's a great question. And so a lot of people have asked this. Many people over the years have said that they are, in fact, Satoshi Nakamoto. And so, one of the more famous ones was a gentleman named Craig Wright, who's an Australian computer scientist. There's been a lot of supposition that it might be the late H.Y.P.E, who was one of the early contributors to the technology. The truth is that no one knows. And one of the ways that we would actually be able to provide this is that using the technology, all of the Bitcoin that Satoshi ever had is actually still sitting in the same wallets that were created back in 2009. And so if someone were to want to prove that they were actually Satoshi, they would just be able to simply show that they actually are able to move this Bitcoin from one wallet to another. And thus, I can prove that I'm the one that was originally creating this and that I was here. But what would the impact be? I mean, really, frankly, in the long run, it wouldn't matter. I think unless you're going to have, the CIA come out and show that they were the ones that built Bitcoin, one of the things that really at this point is that it's become its own beast. The code is entirely open source. So even if Satoshi were to come out and say, this is me, this is who I am, these are my beliefs, the fact of the matter is that because the network is out there, it relies entirely on the different individuals that run the technology and those that each of us could essentially be running this on our laptops. It opens up the network to be decided by the people for the people. And it sounds a little bit, a little bit grandiose and a little bit on the patriotic side, but it's true, is that the network is essentially out there for deciding what happens next is left to the people. So realistically, if Satoshi did come out and reveal themselves, at this point, I don't think in the long run it would make a difference because the code is entirely out there for the world to decide what happens next. Hope that gave a little bit of color. But were there anyone else that was?
That was the only one we had so far. So thank you.
Perfect. So maybe we'll dive in a little bit into this in terms of, I'm talking around building this internet money and how this all come together. It's a little bit grandiose, and I understand that. And so this is where there's a bit of a distinction, is that Bitcoin itself was one of the applications for what we call blockchain. And blockchain, very simply, is going to be a distributed system. This is where it gets a little bit on the technical side, but we'll keep this kind of light for now. We can dive in if you guys want, but to understand kind of where we went from the current system to now, the current system in terms of financial intermediaries is that all banks that are going to actually be able to interact with the system all check back with a central ledger. This could be the central bank of a country. This could be different institutions, but they all rely on trusting one another in order for the ledger to be kept up to date. And the easiest way to think about this, for example, is that when I go to charge my card at a store to buy a cup of coffee, when I'm actually handing over my card there, what's happening to horrendously simplify everything is that the bank itself is then going to receive a request from the store saying, does Sean have this amount of money? If yes, transfer it to the account of the store. And then once that's been done, it will change the amount that is written in the ledger there. Say that a cup of coffee costs $5 here in Bermuda. It's quite expensive, miraculously. But we'll say that $5 is going to be gone from my account, and $5 will then be written into the store's account. That ledger is only going to be kept with the bank. No one else is able to see how much money is in my account or how much money is in the store's account, but we trust that the bank is going to change the ledger appropriately, and as a result, I get my coffee. And so the way that this has changed around with blockchain technology is that the public nature of it is that I'm actually able to say that when I go to charge this cup of coffee to the store, and let's say, for example, I'm going to say it's $5 priced in Bitcoin, there'll be a couple thousand Satoshis or whatever it may be. That amount is then going to be checked against the network. And the way that this works is that every time that a transaction is going to happen, I'm going to then be able to say, I'm sending $5 to the store. The store is then going to request out to the network and say, is this true? Does Sean have the $5 or the five, let's call it in this case, the Bitcoin that he needs to have in order to buy this coffee? And in this case, the network itself will have a record of how much is in my wallet. And so it will be able to say, Sean does have this amount. We're going to transfer this amount to the store, and the transaction will go across on the network. And now essentially we want to say, well, okay, that sounds good. Everyone's able to now to transfer this value around. Everyone's able to say that it's essentially just this internet computer running around us in the background. But what if someone tried to break it? What if I was saying that I'm now going to, oh no, I actually have twice the amount of money that I have. I didn't send the $5, but I've already got my cup of coffee. Well, that's where the decentralized nature of the network kicks in. If I, for example, write on my copy of the ledger saying that, oh no, I have $5 more, every single time that a transaction is to go ahead, the network always checks against every other record that is out there. And if it doesn't match, then the one that is wrong and that is rejected from the pool is the one that's going to be kicked out. In this case, it's mine. It's my fraudulent attempt. So if I'm going in and saying that, oh no, I actually have more money than I do, the rest of the network is able to self-regulate and say, that's not true. We all have very different records. And so by this, it's consensus by the majority. It allows for it to be permissionless because we don't necessarily need to have anything involved where there's a central authority checking about this. The rest of the network is going to self-regulate. And what that all means is that this results in us having a distributed ledger around the world, which is both going to be immutable in that I'm not able to actually go in and change it myself. I have to broadcast it out and gain the network's consensus before this goes ahead. But it's additionally pseudonymous. I'm sure many of you were thinking in this example that, well, hold on, I don't necessarily want to have people, seeing how much money I have in my wallet as I'm broadcasting these transactions. And one of the key facets that we all, one of the myths that was around in the early days of Bitcoin was that it was entirely anonymous. And it's not true. All of the information is publicly broadcasted to the network. But obviously at this point, the wallet itself and this amount of money is not traced back to my name. So there's different levels of security, but much the same way that, I'm able to essentially kind of show my ID at a bar. I don't necessarily need to give out my home address to prove that I am in fact 18 years old. I can just show my birth date, and that's the information that's broadcast. So in much the same way, blockchain technology has different layers of privacy features that can be given out there. So it's not all going to be just broadcast. But the important part that is that it's actually going to be checking the transactions against each other. And this is where, once we're going through this process, the way that the blockchain is able to continue to guarantee this is true is that each time that a transaction happens, for example, what you see, this hash, as it's called, is essentially layered on to say that the entire network has agreed that this block is correct. As we then look into the next one, this one is then going to be linked into the previous transaction. Another transaction goes ahead, someone else buys a cup of coffee. Everyone agrees of what are all the new amounts in each of the ledgers. Once everyone has reached consensus, this new hash is generated using the information from the old one, and so on and so forth. And so it means that if I try and go back and say, well, oh no, back in this one, I actually had an extra $10 in my wallet. Well, this resulting hash would be very different. And as a result, this would then mean this is different, and this is different, and this is different. And the entire network would know that I've submitted some false information. And as a result, all the transactions afterwards cannot be trusted. And again, we go with the longest and most trusted chain, meaning that we're going to go with that the majority agrees upon. And this is the way in which the entire system is self-regulating. So that's all done through a system of essentially doing a lot of mathematical power in the background. But that's the high level of what exactly is being checked against every single time that this goes ahead. And so we won't go too deep into this part, but this system of being able to check in the background that transactions are correct is also done in a way that those that are validating the network are also going to be rewarded for their efforts. Obviously, you want to have some sort of incentive that allows for people to then say, okay, I'll contribute to helping the security of the network by giving my computing power. And in this way, this is what we call proof of work and the actual mining of Bitcoin. And so you've probably all heard about different Bitcoin mining farms and a lot of the discussions around there. But essentially, what happens is that when in the background these transactions are being processed, these computers are trying to solve very complicated mathematical problems. The first computer that manages to solve the problem correctly and broadcasts that they've got the answer is then checked against by all the other computers. And it said, okay, they got it, fantastic. And if they did, that's when the network then issues new Bitcoin out, much like we had with the gold mining example, and is then given to the miner as a reward for their helping of securing the network. And so this is the way in which we have miners around the world are able to contribute their electrical power, their computational power, and to be rewarded with Bitcoin, which they can either be sold on the open market, they can keep it themselves, depending on what they want. But it's the way that the network continues to guarantee its own security. And so part of this is that at the end of the day, blockchain technology is always known about being used as a Bitcoin solution. But essentially, blockchain can be applied with the same idea of this distributed ledger that's trusted with anything around the world. It's acting as a single source that is immutable, it's transparent, and it's global by design. And again, we're trusting in the system itself, not trusting in any individual party, any central intermediary, or any government as in the old system. And additionally, this is the way that for a lot of the technologies that we're looking at nowadays, some of the business applications is that you could, for example, create an audit trail of all of your digital data. You're able to also have identity on chain and provide that there's a sort of way of reducing the risk of fraud and counterfeit, that a good, in fact, did come from a certain place, and that we're reducing a lot of the errors and the costs associated with having to do an awful lot of back checking against all of the different records. Because again, everything is going to be broadcast to the network and it's all publicly verifiable. So that's a little bit of kind of the background of here's the technology itself, here's how this all comes together, and here's some of the ways that we've seen a bit of the growth. But Manny, I'm aware that we are going a little bit slower than usual in some of these presentations. I can go a little bit into kind of the growth of the space and everything, but I wanted to pause again if there's any questions.
So no, you're doing fine, and I think everybody's it's been good so far. I think we do have a question regarding, like, if all of this kind of stuff is going on and it's got to be compared against all of these different ledgers and stuff like that. Like, how does that work with latency, and how long, is there actually problems ever with a transaction not happening quick enough or not happening at all?
So excellent question. So one of the things is that so the Bitcoin network itself, if you were to buy coffee with Bitcoin, firstly, that's going to be a slow process if you're working directly with the network. The transaction times, as you're alluding to, tend to be around 10 minutes. Of course, that's long enough that I've already drank my coffee. The store is angry that I'm still waiting around inside, and I don't want to necessarily wait 10 minutes every time I'm trying to do a single transaction. And so the way that this technology has been built up upon this is essentially that while the base layer itself, the most secure one, is done every 10 minutes, there's additional layers that are built on top of this, which are able to do much quicker transactions. On Bitcoin itself, for example, you'll have one that's called the Lightning Network, which, as it alludes to, is a much faster solution that is built on top of Bitcoin. And so the way that Lightning works, to simplify a lot of it, is that by agreeing to use Lightning, again, another decentralized system built on this that I don't need to trust any individual party, we agree that everyone within this pool is then going to say, okay, I will agree that every 5 seconds or so, it's going to actually then update the ledger. Now, once those transactions have all gone through, Lightning itself will then settle everything back on the original Bitcoin blockchain. And it means that we're able to have different scalability solutions built on top of each other that are able to actually provide much faster transactions. Because much as you're saying, whoever it was that asked that great question, you can't wait 10 minutes for a transaction. That's not feasible in today's world. And so that's the one that we see that, the original base layer of Bitcoin will often be used for, in our view, a little bit more of the institutional settlement. It'll be done more on the banking layer. It'll be done more by the larger partners. But it means that individuals like you and I are also able to use applications like Lightning to transact against one another and then continue on with our day, knowing that the system is going to settle trustlessly against the original Bitcoin blockchain. So I hope that kind of answered. Does get a little bit technical, but there's a lot of very smart people that are working on solutions like this in order to rely on the base layer of security, but with that same level of ease of use that we're used to, much as we are with Visa and MasterCard and others. Any other ones there? We're good?
Well, we had a question on, are there limits to, I guess, the extent of the blockchain? Like, how extensible is it? Is there a point? I mean, I know that there's a point at which Bitcoin itself, obviously, there's a theoretical limit to the number of coins that can be put out there, even though it can be split up in these smaller numbers. But so, and I don't know, I mean, is there some place where at some point we go, oh my God, there's just too much blockchain and it all crashes?
So I guess this part of it, two different questions there. So one is, what is the limit of the Bitcoin system, right? And so if we're looking at Bitcoin specifically, we know exactly how much Bitcoin is issued out every time. And so the way that the Bitcoin network rewards is that in this case, every 10 minutes, like we spoke about, when the network then decides, okay, all of these are the correct transactions, that's the time at which the reward, the new Bitcoin, is actually issued out to the miner that solved the problem first. That then is essentially going to happen every 10 minutes and every time a new block is created for the next 100 and something years. And so the issuance schedule as it is essentially that we know that the Bitcoin that will be issued over time is decreasing. And so by the year 2140 is roughly approximately when it's going to be predicted that, assuming that we continue on with the 10 minutes every time, that's how long Bitcoin will continue to be issued. Right now, there's more being issued than there will be in the future, because every so often and programmatically every roughly 4 years, the amount of Bitcoin that's issued every block does get halved. And so over time, we see this decreasing supply. So you do have a much more stable level of issuance. But when you're saying, well, what if we just have, is it too much? Is there too much information? That tends to be when people look at something like using blockchain itself for what might be not necessarily a Bitcoin application, but for example, an information application. And so the way that you can use something like blockchain could be that we all, for example, keep record of, who was, let's say, what's an example here? It could have been your Super Bowl winnings. Let's take that one as an example from earlier, is that, I think it might have been Manny won in the third quarter, someone was saying, and we want to keep record of all of the winners of this. And so instead of us needing to have a financial system for this, we just want to have the information saved on a chain. Now, this is entirely possible, and it might be that that people will just set up one of their applications and say like, all right, I'm going to all of us need to have a level of trust, because I might be trying to say, no, I'm the one that won it. And so we want to all be able to agree upon, who were the winners and have that information broadcast out. And so any way that essentially there's a system in which there needs to be trust among the participants is an area in which blockchain could make sense. If you have a trust, if you can already trust all the partners involved, you don't necessarily need to have blockchain, right? So if you're all on the same football team or something like this, you don't all need to say like, okay, well, who won? Because we're all agreed of kind of a consensus has already been reached. But as soon as you involve another team and there's another kind of dispute between, who is essentially going to provide the actual truth, that's where there can be an application of blockchain. But essentially, can it all come crashing down? Well, it all comes down to relying on the miners, those that are securing the network. And as they continue to secure the network and they receive their rewards, they're further incentivized to keep doing so. And so really it's a self-regulating system that if a bunch of miners just packed up and left, the system itself actually auto-adjusts the difficulty involved and then allows for there to be more likely issuance out to each of the individual people. And as a result of this, you actually have a system in which if a bunch of miners have left and these miners are now going to come in and say like, okay, well, I see an advantage here, they're more likely to be the ones that receive a reward. So if it all comes crashing down and there's people that leave, more people will fill in and supply and demand takes over. So it was a little bit of around the answer. I hope that was answered what was originally asked there.
Yeah. Thank you.
My pleasure. So I'll dive in a little bit more into here because I'm sure there may be some other questions that will arise with this. But part of this is to say that Bitcoin was the genesis. Bitcoin was where things began. But since then, we've seen the growth of many other applications. And this is probably where that question might be saying, well, what else can happen around this? And that's where we had the growth of what was called Ethereum. So Ethereum, as many of you may have heard about in the news, essentially was one of the original cryptocurrencies that was also built out in around 2015. And essentially with Ethereum, they took what was the basis of Bitcoin, being that we have this idea of digital money, we have this digital gold, whatever it may be, but we want to build a little bit more programmability on it. We want to say that if this, then that. And Bitcoin is very good at being a secure network that's considered to be this sort of digital gold, but it's not great from a programming perspective to be able to have very complicated functions. And so that's where something like Ethereum rose up. Ethereum and the foundation behind that realized that we want to have what's called smart contracts, meaning that, for example, upon something happening, this second action will happen. And an example could be that, I am going to say that, I owe Manny $20, and as of this date, it's going to pay back. Ethereum is going to say that, okay, it is now February 15th. And as a result of that, Sean now has to transact $15 to Manny. That could be something that's preset with Ethereum that's trickier to do with Bitcoin. But this is where Ethereum was allowed to build out the system of just, if this happens, this is what's next. And you can build these smart contracts out into thousands upon thousands of different functions that check back against multiple different data sources and are able to provide, again, this decentralized confirmation of trust. And from Ethereum, we've seen the growth of so many different aspects around here. We've got ones like Uniswap, which is essentially kind of having a digital brokerage out there for the world that can't be stopped. We have Brave, which is actually the browser that I'm presenting this to you guys today. Brave is essentially a way of using what is like a Chrome browser, but being able to make sure that people are able to have privacy enabled. And there's many other functions. And we've all seen the growth of NFTs, which we'll talk about in a second. But all of this is to say that, what happened here and what did Ethereum bring about? It allowed for us to have what we call initial coin offerings. And in this, you can think of it kind of like a Kickstarter, in that if I come out with a great idea and I say, this is what I want to build, but I'm going to need, $2 million for it. People would be able to put that original Bitcoin or that Ethereum into a wallet. And then as of a certain time, they would then receive my token back to them. So in this case, for example, with Brave, when the idea was created in 2000, and I think it was 2014, 2015, Brave was essentially built to say, we want a privacy enabled web browser. And we're going to do this by raising money. And so the person behind it, Brandon Ike, who's the creator of Mozilla Firefox, he actually came out and said, this is what I'm looking to build. If you think this makes sense, put your crypto into this. Many people did. And as a result of that, they received what were called Brave tokens. This idea, this new cryptocurrency created that was able to reward those that wanted to actually financially contribute to these projects. And as you can see, some of the money that was raised by each of these different projects was incredible. Brave raised $35 million in 30 seconds, whereas some of the others like EOS raised $4 billion over the course of a year-long initial coin offering. And others like Bancor and Filecoin have also raised a huge amount of money. A part of this is really also saying from here, there's different verticals that have built out. We have stable coins, which as the name implies is, having essentially a digital dollar that is in fact not going to be as volatile as Bitcoin. We've got utility tokens like Brave that I mentioned, like Bancor and Maker and others. And we've also had security tokens, such that a security like Amazon or Tesla would actually be able to have a digital representation that is traded on this online exchange. So instead of having to deal with a 9 to 5, Monday to Friday, you would actually be able to have 24/7 coverage and be able to have 24/7 trading of these individual stocks. And each of these ideas is all built on the base layer of different blockchains. And again, this is where, you might use Bitcoin or something like this because you want to have much more of a level of stability and you understand that it's much, much more secure. But you might also be looking to have something that's a little bit faster. So as a great question from earlier, what if you're looking to have something that you need very, very quick transactions? Well, something like Stellar is then able to be a solution that's a different blockchain that's built to solve this problem. We already spoke about Ethereum, but there's other ones like Cosmos and Cardano and Algorand that are essentially trying to make innovations on the original idea and to provide another use case. It doesn't mean that they're necessarily competing against Bitcoin. it means that they're trying to solve a different problem. And really, within this is that so many of the different applications that have come out, including ones like Helium, which is essentially, think of like a decentralized internet module that you can have, that will have at your home. We've got Brave, we've got Chainlink, we've got Maker, and we can chat around some of these different applications. But the idea here is that each of these different decentralized applications, or dApps, as we like to call them, is essentially trying to solve one particular problem. These dApps in particular are then going to be built on top of the base layer blockchains. So to give an example here, Uniswap that you see here is this decentralized exchange that I mentioned. Uniswap is a way that I could open up my browser and go ahead and that I would want to trade, for example, Bitcoin for, if I want to trade, Ethereum for, let's say, for Brave, because they're built on the same network. I would then be able to completely decentralized manner trade my Ethereum using Uniswap and get my Brave tokens. But Uniswap itself doesn't need to have a base layer blockchain. They provide a utility, and they use Ethereum for the security. So it's in this way that you have this base layer that can have all of these applications built on top of it. And each of these dApps is then able to focus on their specific use case. And so you can think of the entire blockchain space very much as this idea of different Legos that are being built upon each other that rely on the foundational security, which is
Sure.
why.
Can I break in with a question?
Yeah, of course.
So for these companies like Uniswap, these companies that are making these applications for to interact with blockchain, how do they make money on this kind of stuff? How would a business, like, why are they going into business to do this stuff, and how does that relevant to the people on this call? Like, obviously there's a bunch of this going on, but I don't know how what their game is as far as being able to make money off of this stuff.
Sure. So great question. And so if we're taking Uniswap, for example, as the example, Uniswap doesn't exist as a company. There's no Uniswap Inc. that is able to sit here and do this. But the way that Uniswap exists is that when they were created, they issued out Uni tokens to any individual that was looking to be part of this. And if I, for example, own Uni tokens, you can think of it like having a stock that pays dividends. And with every trade that's done on Uniswap, and I think they have a couple billion that is going through every day, Uniswap then pays out a small percentage of those revenues out to the individual holders. So unlike having a centralized company that's going to keep all of its profits internally, anyone can go ahead and buy Uniswap tokens, and they would then receive portions of these dividends for the revenues that are running through Uniswap's program. So it's like having, for example, a decentralized something like NASDAQ, that I could actually be an owner of this. And if I believe in it, I purchase Uniswap token, I hold this, and I keep my money back. And much the same way, for example, Helium is the other one that I mentioned here. How could each of you get involved in a space like this? Helium, for example, is essentially a decentralized internet router. All of you have one sitting around your home that you're essentially, you rely on this in order to be on this call. But what Helium did was they said, well, okay, the Rogers, the Bells, and the other ones of the world are very centralized. What if instead we had a decentralized internet? What if each person that was able to broadcast out and to help support this network was then rewarded for the tokens? And in the same way, I have a Helium router that is sitting back in my apartment in Montreal. And by being able to help support the network's growth and by allowing other people to route through my router, I actually get paid out a daily dividend from Helium, this protocol. It's not a company, but it's just automatically money that is coming into my wallet. And so there's things like this that, the shift of mindset from, investing in a traditional company. Instead, now you'd invest in each of these individual tokens, which can then, in some cases like Helium, you can essentially receive the dividends from the network. With Uniswap, you're going to receive, essentially the dividends from revenues that are traded. But each of these is different ways that you can get involved, own a piece of the internet, and actually get paid back out for it, rather than it going to centralized companies. Does that give a little bit more clarity there?
Yeah, no, I think that's very interesting that this is, besides obviously the concept of what can businesses do to take advantage of these things, that there's obviously all these new models that are coming up there that allow the individuals or businesses to make some money on the side for using these technologies without being a miner necessarily.
And that's the thing, yeah. And so, one of the other ones, for example, is that when you look at some of the ways in which businesses could actually get involved, one of the things that in particular, let's take a look at something like the Ethereum network. Ethereum is actually in the process of switching their method by which they confirm consensus. So in that, much as we talked about the miners, Ethereum is going under a massive upgrade that is then saying that they want to go to what's called proof of stake. And very simply, you can think of this that if I hold a bunch of Ethereum and I'm then going to validate those transactions, much like the miners did in our previous example, I would then say that, I'm putting up this amount as my stake. I'm going to validate the transactions. And if I try to submit a fraudulent transaction, well, you can take my stake. You're allowed to, then it gets dispersed out essentially. And so in this way, you're obviously incentivized to keep the network honest and to keep it completely validated properly. And so if you hold Ethereum, for example, you're able to put these assets into a pool that then receives issuance from the network out to it. So Ethereum, for example, I think is looking to offer something between 9 to 20% annualized returns just for holding the asset and having it sit and validate these transactions. So for people that are looking to, get involved and have their assets actually do something, I challenge you to find a bank in the world that will pay you 6%. But Ethereum, for holding the asset, is going to actually issue out to each of its holders 6% for those that are validated. So there's ways like this that you can actually get involved and start seeing your money do stuff. I have a couple different wallets on my phone that, when I have some of my money sitting in here, it's basically sitting in these pools. But because I'm saying, I trust in this provider, I'm then able to put my Ethereum into that. And I receive issuance because I'm part of helping the network grow. I'm part of what's the reason that the network is keeping secure. Because if I act dishonestly, or if the pool in which I'm working acts dishonestly, then therefore, like, we could lose our money. So obviously we want to act in a good way to continue receiving these dividends. And there's ways like this that you can get involved. And I'll follow up as well with some resources of all these different ideas that might make sense. But this is a lot of the different ways that, instead of all of this money going into the actual pockets of the company, of the founders, of whatever it might be, anyone can buy into this. Anyone could buy into what essentially is the new, this NASDAQ idea. Imagine being able to buy into, Facebook from the early days and then receive a portion of their ad revenue. Same thing with Google is that for every search, what if you received a small portion as a holder of the stock, or in this case, the token? And that's kind of the way to think about a lot of these, is that they've decentralized, or essentially they've opened up the ownership structure to allow anyone to be involved. So that's a little bit of kind of like some of the ways you can get involved. So I'll jump ahead as well. Some of the areas, like you can see some of where we've come, where we're going. And a lot of it has been the shift, as I mentioned, from the centralized system currently over the far way into Bitcoin and Ethereum. There's different solutions out there, like central bank digital currencies that governments are looking to get involved. But I think part of this, that, one of the ways that we're also seeing a lot more businesses actually use this technology are with stablecoins. And, as I mentioned, as the name suggests, essentially, this is meant to be that, unlike the value of Bitcoin, which can rise, which can fall over time, stablecoins are meant to be this digital dollar, this digital representation that maintains its value. So much like we want to have, this idea of when I go to pay for my coffee, I don't want to have to worry that, Bitcoin has fallen and now I have to pay more Bitcoin for my coffee, or Bitcoin has risen and now I'm giving away my higher value asset. I want to know that I'm paying $5 for that $5 coffee. It's a horrendously expensive coffee, but bear with me. Once this is agreed upon, we all say, well, what if we had some way of having a stable coin? And this is where companies like Tether or USD Coin have essentially come in saying, their currency, they're backing their currency with dollars in a bank account. And so with USDC, for example, USD Coin, there's a group called Circle that is the company behind this protocol that will then hold the same amount of dollars that they have in a bank account, will then be represented digitally on chain. They're constantly audited, they're constantly validated, and it can be guaranteed that the $1 coin on the blockchain is equal to one digital dollar in their bank account. So if I ever wanted to actually redeem my fiat dollar, my government-backed dollar, I could trade in my USDC for a fiat dollar. And so this is the way that they guarantee a level of trust. Obviously, there's a bit more of a layer of centralization because we're trusting in Circle, but it means that companies like all of you on this call are able to trade USDC much more easily than if, for example, they were wanting to trade Bitcoin back and forth and having to worry about volatility. And that's one example that, we, for example, as Penrose, we accept USDC as payment many times because clients want to pay in, a digital format. They don't want to have to deal with banks that take often days or weeks to settle accounts. I've had more than enough experiences of trying to get paid from clients around the world that just don't work. And we end up getting paid in USDC. And instead it settles in a matter of minutes rather than having to wait for all the checks and balances. Now, there's obviously a lot of discussion around, anti-money laundering and ensuring, anti-terrorist financing, but there's checks and balances that are being built into this. It's not the Wild West that it was in the early days. People are able to use these services in fully legitimate ways. And so stablecoins are definitely an area we can chat a little bit around, what might make sense for you guys. But part of this as well, I do have some on NFTs, but I feel like we might be opening up Pandora's box. We dive in.
Before you get into unfungible or non-fungible tokens, which I think everybody wants to hear about, there's just a couple questions I think that are still relevant to the conversation we're in right now. One of them is like, are governments like, are they and can they, and how might governments want to crack down on this stuff? We already heard about it in Canada, what's going on, right, with the truckers, and they're trying to, shut down some of the, whether they can or not, they're trying to shut down some of the access to Bitcoin and other things. And then, so that's the first question, I think. And then the second question is like, what's the incentive in the Bitcoin world for these miners that if, in 2041, why would the miners continue to support this network if we think that that's, and I'm sure that's a long ways away, so I don't know how much we have to worry about it, but I think definitely, like, are the governments getting in on the game, and then are they also going to try to shut down this game, and can they?
So great question. So I'll tackle first. I'll tackle the one that's happening this century first, I think, and then we can talk a little bit around 2141, excuse me. But so in terms of, are governments able to stop this? The short answer is no. The longer answer is that it comes down to, this is a bit of a new paradigm that is coming out where governments are recognizing for the first time in history, they're not the ones that are able to control the monetary policy. Now, this is obviously going to be a little bit of a concern. But part of what I think in our personal view, and I'll speak for myself, not necessarily for any of our partners, I think the governments around the world that recognize this as the new development of money are looking to adopt this, in that there's no reason a government couldn't buy Bitcoin. And that in the world, theoretically, of the future, and this is speaking, decades down the line, there's no reason that you couldn't have a solution in which governments around the world all hold Bitcoin as their backed reserve. So instead of, and this is obviously, where this is where it gets a little bit into, well, what happens next? But this is where you say, theoretically speaking, instead of this idea of us having a free floating exchange where you can have, the Federal Reserve printing, I think the total number was something around, I think it was between 60 to 80% of every dollar that has ever existed was printed in the last 2 years. And obviously that huge influx of supply of US dollars then means that all the US dollars that you and I hold in our pockets are worth a lot less, because that same amount of money has been pumped into the system without there being a resulting increase in actual GDP, in actual value creation. And it means that we've now lost out because our purchasing power has fallen, while the money has essentially been put out to, in many cases, large corporations. So that's a little problematic, I would say.
Can I ask a question then? So what if a country like China that really controls the flow of everything that goes inside and out of their, from an internet standpoint, from a data standpoint, what if they decide to just not give you access to these, these areas of Bitcoin where you could no longer get, so would that put a big hamper on the ability to actually do these tradings if they said, hey, that's great that all this stuff's out there, but we can, we control the internet?
Great question. So I think China, again, is a little bit of a different beast. And so if we look at, the Western world that has a little bit, there's more of a democratic governments around here. In that case, how would you stop Bitcoin? If I was the government and said, I have to stop this, what do I do? Well, one, you have to try and shut down the miners. You have to stop people from mining Bitcoin. Okay, you have to go and start taking down factories. You have to go through a lot of political upheaval to stop this. But additionally, there are those that we could be running this and mining on our computers. It would be entirely possible for a citizen-run currency to exist, even if the government said you can't do this. There's no way for them to stop you, in theory. unless they barge down your door, they make it illegal and everything like that. That is just, a step too far with the autocratic regime. And that's really where China has gone, is that they've actually gone ahead and said many times that they've banned Bitcoin. But we actually saw last year, they went ahead and actually made it illegal for Bitcoin miners to exist in China. And so all of a sudden, a huge amount of the mining power and the computational energy that was securing the network was suddenly at a point of saying, well, we can't run here. We have to shut down. And that, I think, will probably be one of the biggest mistakes China has made in quite some time. They then saw all of the miners leave China and they set up elsewhere around the world. They looked for cheaper sources of energy. They found different places around the world that they're now able to set up and continue running their mining farms. And as a result, China has lost the ability now to control the Bitcoin network. Previously, they did have a significant amount of the mining power came from China, much of it in the Sichuan province, which was all run by hydroelectricity. And so by trying to be stomp up and down on the beast, as it were, they then just essentially said, well, now they've scattered out to the wind and you've lost the control that you had when you could have said, what if we regulate properly? What if we say miners are allowed, but you're only able to, contribute up to this amount? Well, okay, that's a different way of controlling it. What if you said, well, we can run miners, but you're only allowed to transact Bitcoin? Okay, well, there would be ways to shut down applications if you went for the companies that are transacting other assets. But again, this network is entirely decentralized. There's no one country that's sitting there saying, well, we control this. There's no one company that says, I have the wallet, right? Each of these wallets exists as open source code on our phone. And so the thing is now the cat's out of the bag. The Pandora's box has been opened, and I think governments need to adapt to this in that they say, well, okay, if we look at a world where Bitcoin is this new digital gold, we should be acquiring this. We should be looking at acquiring and holding our digital gold safely and securely in order to have this digital asset reserve that we now hold for the future. Much as you hold physical gold, I think there will be a way in which Bitcoin lives within the same system, but is much more easily tradable than it is with being able to ship ingots of gold around the world.
All right, so Sean, I think there's a lot of people who want to hear about this non-fungible token thing. So let's get into that, because everybody's like, why would I buy a cartoon monkey for $5,000? And what does this stuff even mean, and why are people buying it? I mean, I have some understanding of it, but I want to hear why. I think there's a lot of buzz around this, so I don't want to miss that section. And if we have some time, we'll come back to a couple of the other questions.
Sounds good. I can dive in here. So non-fungible token is one of the most, I think it's the worst marketing move ever to call it a non-fungible token, because no one knows what fungible means, let alone trying to say what a non-fungible token is. But very simply, a non-fungible token, the definition up here is a unique digital identifier that cannot be copied, substituted, or subdivided, and recorded on blockchain is used to certify authenticity and ownership of a specific digital asset. What a horrendously long description. And so this is where, a non-fungible token, the easiest way to think of this is that, when I am looking at saying that something being fungible, I can trade you $1 US for another US dollar. You're unlikely to really care which piece of cash that I'm giving you, because you know that roughly they are the same. I'm able to completely say that this is a dollar, I'll trade it for a dollar. I can take this down to the store. No one really cares which one it is. Non-fungible, however, is that they're not interchangeable. There's unique properties that make them different in something, even if they might look similar. And an example would be if my dog goes out for a walk with a dog walker, I definitely want the same dog coming back. I don't want just one that looks roughly the same. And so the easiest way to kind of think of like what is fungible and non-fungible is this image. I love this one, and it's one that I'll give a shout out to a gentleman named Jack Butcher. He runs a company called Visualize Value. And very simply, the one on the left is us being able to say, this can be traded around the world. It doesn't matter which one it is. It's just going to be able to say, like, I now have this dollar. But on the right, we have one that's a unique digital identifier. We have something that actually exists in a way, shape, or form that is unique to itself. And that's where we get into our cartoon monkeys, right? This is where we say, like, why NFTs actually came into existence. And NFTs aren't a new thing. The world becoming more digitized meant that we had to have a way of replicating physical properties around the world, such as scarcity, uniqueness, and the proof of owning it in a digital manner. And so non-fungible assets could be things like, a domain name. For example, we hold www.penrosepartners.com. That in itself is a one-of-a-kind domain name. It means that I can't just trade you, techworksconsulting.com for this. They're very different, and we would want to have different ideas on this side. Same thing with event tickets. There's only going to be X number of them, and this one gives me a seat ticket. But much like we've seen with in-game items and social media handles, all of this idea of non-fungible tokens is just saying that it's a unique digital property. And NFTs in this solve for a way of showing that we have digital ownership of something. We'll not jump too far into the history of NFTs, but they've been around in some way, shape, or form since March 2012. And so this being a new buzz is very much the fact that people have recognized that we want to have a digital way of showing that we have something unique, either to show off, either to prove ownership, or just because it's fun to have something. The idea of having an NFT even could just be that you have a digital deed to your house. That in theory is an NFT. It doesn't have to be this JPEG of a monkey. And so, we won't dive too much into some of the presentation here, but, the NFT value chain, we've, this is a big shout out to one of our associates, Jesse Niles, who did a phenomenal presentation on NFT value with blockchain.com. I'll follow up with a link to this if you guys want to watch the podcast, which dives a little bit more deep into each of these. But essentially, this idea was that what if we were able to actually fairly represent the creators, the artists, and those that are creating this? What if we don't want to just have, a picture, a JPEG online? Well, I could copy this. And that's where, we have these core properties that we want to talk about. Is that, if I have something like an NFT that, let's say let us take, for example, my JPEG monkey. Let's assume I have a JPEG monkey as alluded to. Each one of these is unique, fantastic. I can always certify which one is which. They're programmable, they're tradable from peer to peer, and they're interoperable. We're actually able to trade them between different networks and ensure that they're able to go between different people. Again, they're secure because they're built on blockchain and being able to have that underlying security. They're theoretically rare if there's only so many that are there. And of course, they're traceable. We can have the transactions on chain and I can see who actually verifiably owns them. Now, this is a lot to say that, all of these facets is wonderful. But, why am I going to hold this? Well, when you say, why would I have an NFT, is that it's not that you're saying, why would I buy this cartoon monkey? Because personally speaking, I don't hold any cartoon monkeys. It's not something that I think makes it as much sense for a way of looking at it. But it's in much the same manner. It's what we consider something like if you ever heard the phrase the lorem ipsum, that text that exists before there's something of substance there. This is the stage that we are at now, in my personal view. NFTs are just coming into their infancy. We're seeing now the growth of the digital space that allows for us to have digital ownership of property online. And if you want to shift your mindset, it's not that we're trying to bet on which monkey is going to be worth more. It's that now we're understanding that the foundational infrastructure is being tested for digital ownership of the future. So in the same way that, I might, we've seen all the cases of people like losing their digital monkeys and losing, access to it. Okay, unfortunate for the person, but that's something that we're recognizing and building around so that we find the bugs. You don't want to have these same bugs when you're trading the digital ownership of your house, of your car, or even just having things like having the digital ownership of your personal degree, for example, could be online. You don't want to have these bugs pop up. So I think it's a good thing that we are testing this with our cartoon monkeys now while the system is being built out. And we can dive a little bit into some of the process, but essentially, an NFT could be a variety of things. It could be that the creator of, for example, the digital deed is that when a house is built, we've now said that, okay, we're going to have a representation that this NFT, this digital ownership is then going to be placed into the wallet of the homeowner. And that allows
So, Sean,
yeah, go ahead.
Let me state a simple question, right? So let's say I have the TechWorks logo, for example, and I want to make that an NFT. How do I go about doing that?
Sorry, say if you wanted to just make a TechWorks NFT.
So I had I created my TechWorks logo, and normally we would trademark it, right? But I want to make an NFT out of that logo. Is that something that I could do?
In theory, yes. Now, what would be the point, right? You're trying to say, okay, I want to prove that this is my logo. I have the ownership, I have the original, and I'm able to do this. If anyone is just going to copy paste it, well, it's recognized then as they're using your logo, but it's not the original, right? And so
Correct.
In this way, for example, we don't yet have a system that is set up digitally that would say like, I am going to patent this image and I am now showing, what is who is the actual owner. But in the future, theoretically, what we would have is that, for your logo, that would then be essentially patented, created into this digital representation, and it would then be linked to actually say that you are the owner. You yourself are the only one that has access to the original. And that would then reside within your own digital wallet. And that, for example, could just be that you have a way of biometrically tapping into your phone. My phone, for example, can only get signed in with my thumbprint. So I know that if I hold something in here, I'm the only one that can access this with these thumbs. Please don't come for my thumbs. And that's then allowing for us to say that, if you're holding this TechWorks consulting, that's going to be shown that you are the original owner. Anyone else that uses this could then say like, well, okay, do you have proof that this is your logo that you're able to show it?
So would there be able to be a contract assigned to, let's say, it could be a song, it could be my logo, it could be whatever else or a piece of art that I drew that then said, it's not just the fact that this is the original, but the contract that's with that original allows me, my original allows me to get paid every time somebody uses that.
Exactly. And so that's where these things are now growing, is from the NFT perspective, if you look at something like the Spotify model, Spotify is fairly horrendous when it comes to actually paying out their individual artists. But if you had a system that instead of Spotify, we're all sharing this on like something like the SoundCloud built on a decentralized network, every single time that I would go ahead and play one of your songs, in theory, you could then get a microtransaction that then is submitted back to your wallet. It means that we have a solution of, instead of creators having to pay a huge amount of money out to the recording labels and all this, they have worldwide distribution and a way for them to get paid back instantaneously. And that's where these things are going. That's why NFTs are so cool and so fascinating for the future. It's the monkeys and such are really fun now. Everyone loves to see about someone making a couple $1 million off of having a digital monkey, but it's just the beginning. And there's exactly those sorts of use cases where an NFT could be any sort of physical object that has a digital ownership online, or even not necessarily physical ownership, like a song. That's just something, it's a deed of owing. I am the one that created this song. Anytime it is played, I would like to receive X. It allows for people to actually be fairly compensated for their work. And that's exactly the sort of use case.
How does this, what if I say I'm the one who wrote, yesterday? Because, and I put that and I make it like, can I do that? Can I say I'm the one who wrote yesterday, and or some other, piece of work that may not be as popular as that, and I claim ownership to it, and now I'm getting paid off of it?
Yeah, so that's where you're coming into what it's a great question. And so that's really where there's a whole field of study right now of what we call oracles. And oracles are just a way of saying, how do we get the real world data securely onto a blockchain to know that whatever goes in is value? Because one of the biggest critiques of blockchains is that right now, if you just submit something on there, well, it's on there. Like you can't remove it. It's immutable. We can't just delete it. That's not how the system works. So you need to have a way of making sure that it's not just trash in, trash out. We need to have some sort of validated way, exactly as you said. And one of the ways right now, for example, is that you might want to sacrifice a little bit of this decentralized idea in order to have a central authority that says, okay, yes, we can all agree that this is the person. Cool. This is the one. So did you write yesterday? No, it's actually, we're already aware of who wrote yesterday here. We're not looking to have, people come in and fraudulently submit. So there will need to be some sort of gatekeeper that's being involved. It right now will probably be a centralized authority that is able to use this as a way of saying, this digital ownership for these songs, you might still have it recorded with a centralized authority, but in the future, that sort of database might then be decentralized itself. But we do need to have something nowadays that the world is not ready just to be thrown fully decentralized. It would be madness. And that's never been something we've been a proponent of. It's that we're now seeing the benefits of what could be done as freely traded songs, freely traded or compensated artists. And then now we're shifting back into a solution of saying, oh, okay, instead of that, let's have someone that checks the songs up front, but then once you're in there, we've guaranteed it. And that person is then able to trade that ownership freely. So it's a great question, is that, not everything is built yet, but these are the sorts of problems that we're looking to solve as the situation develops.
Right.
Perfect.
So I think that, this has been the general concept of why NFTs have some value whatsoever, because it's not much different than, and Timothy had said the same thing. It's not much different than a baseball card. Why does a piece of paper that just has a picture on it that anybody could kind of reprint have any value whatsoever? I think that's a good way to think about it, is that it's, whether that baseball card, people can make really, really, really great copies of that card or reprint it, but somehow or another, we hold some value in the original.
Exactly. And that's one of the parts, is that you want to have this idea of some sort of way of validating who is the original, right? Like who is the one that actually controls this. And so that's where, we are still figuring out, how do we certify who has the original Babe Ruth card, right? And so right now, for a lot of these ones, people aren't moving everything onto chain. I work with a company that is actually using the validation process for scanning and grading old baseball cards, and then being able to have the digital representation on chain that can then be much more freely traded with the ownership actually transacting.
So if you added a Bitcoin to the if you added this NFT, and they did a scan of it and they did like a digital fingerprint of that card,
Mhm.
now we know that when somebody went to trade that card, it was the original because of some properties that were on it.
Exactly. So, for example, if I'm then showing up to give you the card, you could very, very fairly demand to say, like, okay, show me that you have the digital ownership. You didn't steal this, that you didn't print it, that you didn't have some sort of fraudulent process. And I would be able to verify, here's the original proof and here's the card itself. And once we're giving that over, that's when the ownership is then transferred, so that you're, much as you just hand over your cash, you transact the ownership only when the payment is received. And that would just be a one-for-one trade. And then people can go about their day. And the trade has happened. You can see the transaction has been done and ownership has been transferred. So it's exactly the sort of thing, is that we're still figuring out the validation process, but you can see kind of where this is going.
So I want to, we got about 5 minutes left in this presentation, and certainly if anybody's willing to stick on for a few minutes extra, we'll do that. But I want you to be able to finish with what you think is important before we go back into some questions.
Sure, and really, there's some more pieces on the verification. We have different use cases. I'll clear this as well with one of our team, and we'll actually be able to kind of pull this all together for you guys. But really, I think, to summarize an awful lot of information I've just thrown at you today, part of where I think people need to recognize is that we're only in a 13-year-old industry. Bitcoin has just had its 13th birthday this last January. We're still so early. And so for a lot of these technologies, we're beginning to see essentially, where can this now be applied? And that's where we rely on all of the people on this call to be able to say, well, okay, in my industry, where is there a need for trust? Where is there some place in which we're actually able to say, this has to now be shifted? Because traditionally we've had to rely on, an intermediary, we've had to rely on a complex system, we've had to rely on something that just doesn't work as easily as it should. And in that case, that's where there could be a use for blockchain. So when we're looking at all these systems, it will not be me that is figuring out these solutions of the future. It will be all of you on this call, because each of you understand your specific industry so well. And so one of the ways that we like to do this at Penrose is that, when we start engaging with different clients, we start asking these questions, is that the first thing, we say is always just, okay, where within the system do you require trust? And maybe that's with payments, with money. Maybe that's with ensuring cybersecurity for your data. Maybe that's with just being able to buy and hold Bitcoin and other digital assets securely, because you want to be invested for the future. There's so many ways that you can get involved. And the biggest advice that's the best advice I always give about this and how I got involved in the industry is just read as much as you humanly can and ask as many questions. There are many people like myself that are been working in the space for about 5 or 6 years, and I'm still learning every single day. I'm constantly on the phone with people that are a lot smarter than me and asking them as many questions as I can. And so really, figure out where there is a need for trust within your daily lives, within your businesses. And that's probably a place in which there can be some innovation. And so with that, happy to turn it over, answer any couple questions. I can hang on for a little bit after 11 if anyone would like, but I'll jump back to this as well. And again, thank you so much for having me, guys.
This is awesome, Sean. So listen, I'm going to ask one question I think everybody always has on their mind when they're talking about this or any other new technology, is like, really, like, the question came up is, how hackable is this stuff? Or different ones more or less hackable? Should we be concerned about this? Because we know that, we saw that thing where it was like $3.6 billion was stolen in Bitcoin, and they recovered it, but it was, obviously, or it was in, I don't know what money it was in. I'm not sure if it was Bitcoin, but obviously I don't think that was a hack of the blockchain itself, but somebody that was, that was holding blockchain. But like, how hackable is this stuff, I guess? And that's kind of a very broad term to use, but
it's a good question though, right? Is that because one of the ways, like, again, a little bit of my background was I was in venture capital before jumping into the space. And one of the things I would always ask is, like, how does it break? What goes wrong? Like where is something gonna go wrong, so that we can work backwards from there and say, how do we fix this before it becomes an issue? And much the same way that, in its existence of the last 13 years, Bitcoin itself has never been hacked. All of the things that go wrong with this are with, a centralized exchange that is holding Bitcoin and has poor security. They had a rogue employee. There was someone that, people talking about how, oh, they managed to, their Bitcoin was hacked. You just have poor security. And that's why there's different solutions for holding this in a secure manner. In much the same way as that, we're in a place where we're saying, if you are looking to hold Bitcoin, you might not necessarily want to have it all sitting on a hardware wallet, on a USB drive in your back pocket. You might not want to be keeping it in your online wallet. There's a lot of different systems, and there's a lot of different layers for what you want to have as a secure solution. And so all of this is to say is that there are solutions being built out for day-to-day use. There's those that we have high net worth clients that are looking to say, like, we keep ourselves much more secure. There's different layers to this where you can decide what your own personal risk tolerance is. And if people, for example, were interested in getting, buying into this, but you were concerned about tax implications, you don't even need to buy the Bitcoin yourself. There's different ETFs. There's different solutions are out there that people can actually, have like their Roth, I think it's the Roth IRA, I want to say, for the States and things like this. I'm not used to Canada, so I only know the acronyms up there. But from those, essentially, again, from a security perspective, it's never been hacked. If you want to know what the bounty is on someone being able to successfully hack, the market cap of Bitcoin today is $840 billion. So if someone was to hack that, that's a hell of a big bounty that's out there. And so one of the ways is that this is a self-replicating system, in that even if someone were to be able to break it, part of that is that, there have been bugs discovered over time that there was going to be something that might have been problematic. When it's discovered, people address it because we're all invested in this. And if something was a catastrophic problem that would be discovered in the code, then as a result of that, all of our Bitcoin would go to zero. And so, we'd act to work as a way of saying, well, let's solve this before it becomes an issue. And it is one of the most open and inclusive communities that I've ever seen. And it's one of the best ways that I think that people can get involved, is just having the conversation around, where can you bring some value into the space?
Great, thank you. So, let me see. There's a couple other questions before we close up. We are over time, so I want to say right now, thank you, Sean. This was fantastic. I mean, I think that there's a lot of people who got a lot of great information. I'm going to keep, if you're okay, I'm going to keep on for another couple of questions, but I do want to thank everybody. I want to thank the Young Professionals Group for joining with us at the HIA, for always being a good supporter of these events, and all of our cohorts that help us out with the Tech for Business Committee, putting this kind of stuff together. Thank you, everybody. We'll stay on for a couple more minutes. I got a couple questions that I think kind of still relevant, and then we'll call it quits. But I do want to thank everybody for joining us. The Tech for Business, we meet usually the first Wednesday of every month. So guys, we'll put out some more stuff if you want to know. And this recording will be shared out to you guys. So we'll have it shared out on ours and to the attendees. So a couple other questions that went out there that we didn't get answered was the question about 2140 and why do people, what happens at the end of all of this?
Right. I'm not allowed to just dodge the hard questions, right? Good catch on that one. Sorry, I completely slipped my mind. So 2140. So great question. So what happens then? Well, that's one of the ones that a lot of people are trying to figure out, is that, if we're building this digital gold of the future, if we're trying to say, this is going to be the solution for us to hold generational wealth. Well, we can't have this break in 100 and something years. We do need this to last. And of course, if the world is now shifting into a solution where you aren't able to have new Bitcoin issued, we all agree that, it is absolute going to be it is the pinnacle of Bitcoin, that there will never be more than 21 million. I would put money on that. I have literally put money on this by buying into this. There will never be more than 21 million Bitcoin. And so one of the things that to keep in mind is that this is an ongoing and developing system, is in that we believe in the miners that are around the world and that are the ones contributing to the system. One, anyone can join, right? That's the first and foremost thing, is that anyone can join this in order to become a miner, in order to validate transactions, and in order to run what's called a node from their own system. Are you likely to, mine a whole Bitcoin by yourself? No. But are you able to contribute to the security? Absolutely. And part of that is then saying that over time, one of the questions is that, when we do get close to this, and as the Bitcoin issuance is dropping, what's going to happen? And one of the solutions that's actually on there is that it's likely that there will be something along the lines of a tiny percentage of transactions are then going to be distributed back to miners in time. So that as we begin to shift out here, although there might not be any new Bitcoin that are actually mined, there will still be the network security in order to be able to actually say that by the point of 2140, if, as things are going as it seems, and if Bitcoin does actually hold out to be that winner long term, there will be a large percentage of the world's economy transacted in this sort of system. And as a result of that, if you're then going to be securing this network, there's going to be a huge incentive for that to still be a valid and secure network. So the code itself could then be distributed over time to shift into saying, okay, upon 2140 hitting and upon there being no new Bitcoin to come out, there will be a percentage fee that is going out to distributed to the miners that will then be all of those that are securing the network will then be compensated in time as well. So that's one facet, is that this is an ongoing and actively evolving system. And one of the things that, in particular, the Bitcoin Foundation, or excuse me, the Bitcoin, I believe there is a Bitcoin Foundation. There's a bunch of different organizations that run a lot of these conferences and discussions. One of the ways that they are critiqued is that they are very slow to change. I think this is a good thing, because they are, for example, planning stuff out that will be deployed in 4 to 8 years, and then in 20 years, this is how they think about it. But they're not looking to make drastic shifts. And part of that is that there could be an agreement in 80 years that we all say, okay, this is the global system. All the miners are set up and secure, and we're able to have a solution that now all world trade is settled on Bitcoin at the base layer. Fantastic. We'll all agree that there will be X% transaction fee that will then be distributed out at the end of this period. And then anyone securing the network is then going to help validate the system and be paid out appropriately. So that's one way, is that like it is far enough in the future that we don't need to worry about it right now. But we should be setting up the proper consensus mechanisms in order to be able to discuss these things before they become an issue. And that's one part that, in particular, for the Bitcoin side of things, and even for Ethereum and other foundations, the more distributed you have the tokens, the more Bitcoin out there and freely split up amongst the world, the more Ethereum is more freely distributed. You have more people that are invested. You have more people that want to contribute their voices and their thoughts to the process. And that's one of the ways that the blockchain industry as a whole is in itself going to naturally drive many people into the system. It will naturally be that those that are buying in are now invested into this and want to see its long-term success. And so with that, why would you vote against a system that you hold money in? You wouldn't. And that's one of the self-regulating aspects.
Right. So I think we have 2 more questions, and I think we'll finish up. So one of them came in that said, we talked about stable coins and being backed by the US dollar, but then there was this idea that this company Tether actually failed an audit, and they were supposed to be this original stable version of coins. And so what happened there, and how do we, there's obviously, there's always risk averse people that are going to be looking at that, and investors that say, well, sure, like, you don't have to invest too much to get started. A lot of people were risk adverse at Bitcoin when it was $300, and then sure they were risk adverse at $1,000. So how do you balance that and say, what's going on in the industry that says we're not going to have another Tether on our side?
Great question. And so really that's where, again, it comes down to pick your poison, as it were. You can pick which one of these centralized authorities that you want to put your trust in. And so obviously, you don't want to have to go through all the vetting for each and every coin. That's where the market really steps in, is that, if something is going to last for the longer term, it will necessarily be held in such a way that, there are different companies that are being very heavily regulated. Tether is one that, for example, I think Tether came around, I want to say 2014. I believe it was Craig Sellers and his team originally. Tether failed an audit. And that means that in this case, for those that may not be aware from that time, I believe it was 2018 when essentially they had a large scale audit done, and it was shown that they did not in fact hold sufficient money in their reserves to represent the money that they had on chain. So obviously, if there's now a system of saying, well, I can't trade my $1 of Tether in for an actual dollar, that's a concern. And we're going to have a bit of a run on the banks. And so in Tether's case, for example, Tether is one that I think, again, there's personal opinions here. Tether is one that has always filled this idea of being a less regulated coin. They've been this idea that there was huge trading volume across Asian markets that were just looking for a way to trade in and out of Bitcoin and other cryptos, but they had no intention of ever actually jumping back into fiat. It was used as a settlement mechanism. Whereas if we're then looking to have something that would actually be a longer term hold for a stablecoin, that's when you'd look to something like a company like Circle, and using the USDC coin, which was actually one that, for the Circle, for example, they're actually incorporated and registered in Bermuda. They've passed the very strict guidelines that are held out by the Bermuda Monetary Authority. They've received their digital asset license, and they now have to uphold certain standards like continuous audits, like proper verifications, numerous security controls, and things like this. And so if you are looking to, hold, stable coins on your balance sheet, obviously that's something that, you want to ensure that this isn't going to pop to zero tomorrow because your business relies on this. And so in that case, that's where you want to look at something like these regulated entities that if you are still looking to have a centralized digital currency, you're going to go with a centralized authority that is well respected. Whereas if on the other side of things, you're saying, well, I believe something like inflationary pressures will continue to rise. Holding dollars just doesn't make sense for me. And in that case, I'm going to go for something that's a little bit more inflation proof. That's where you're going to look at something like Bitcoin that is then able to say, there will only ever be this amount of issuance. And as a result, I can pretty much not necessarily guarantee, there's a likely chance that I will beat out inflation because of the fact that there will not be a huge amount of issuance. So when you're looking at companies that are saying like, I want to use a payment method to get up and running, you are going to more likely be able to select which ones you want, like the USDC, which is much more regulated. And so Tether is one of those ones that I think will be a bit of a stain on the industry for a while. But much the same as we've seen things like, if anyone remembers the infamous BitConnect Ponzi scheme, there's always going to be ones that that pop up, and people will try and take advantage of the population. But I think over time, the industry is becoming more regulated. People are no longer these anonymous teams, and there are actual repercussions to trying to launder money or launch a scam. And so obviously, as this becomes a more steps out of kind of the shadows of just being, this internet money that's kind of transacted secretly, we're now becoming much more of a global phenomenon. And I think that's where the legitimacy is brought to the space each and every year.
So my last question has to do with the NFT piece, and the question comes in is that as we're making these NFTs and or people are starting to make NFTs, have there been any cases where already people have said this was my work? I'm an artist that made something that nobody knows about, and there's not really some way to authenticate that, but this was my work, and somebody else made an NFT out of it?
Yes, that has happened, and so there will be plenty of those that are at the point of trying to trade your digital monkeys and all this. How are we actually validating? Well, where did this art come from? So more often than not, also we're seeing a lot of original artist fans will also recognize that this isn't in fact this wasn't traded fairly. And again, it comes back to being able to say, what is that step of validating from the real world into the digital world? How do we have that guarantee? And right now, there isn't a solution. There isn't one facet that you're able to say, this is mine. This is now going to create this. I can verify that this is mine. That's going to take a little bit of work to figure out, from the perspective of the ownership that is claimed in the real world. How do I know that I created this? Well, okay, yeah.
So if you were an artist, let's say, or you were somebody who was making this, is there a way, even without getting on the blockchain or something, to say, hey, I know that this is the original work before I put it out as an NFT? Or is there a way to secure that stuff? Like if I was drawing a picture right now and I drew this digitally on my iPad or on Photoshop or whatever, is there a way that I could say this is where I did it and it's validated original, and even though I haven't made an NFT out of it yet?
Well, it's really that's a problem in today's world that could be solved by blockchain, but it's not necessarily, how do I validate it's mine? Have yourself a well publicized Instagram page. That's kind of one of the ways that most people are able to kind of have their ownership. Like if a brand came in and tried to claim it, what is the solution of saying like this is mine? It's a problem.
You're saying we could put it out there as some kind of a public record to
Exactly.
start.
Exactly. And that's where, one of the beautiful things about this is that, this entire system is built to be fully transparent. It's meant to be in a way that, I don't necessarily need to tie it, that saying that this is my art owns to Sean Stapley, but this art would be posted publicly and tied back to a wallet that I would control. So I don't need to put my identity out there, but I can say that, this is the wallet that controls this. And this is always the one that will be the original owner. So it could be, like Banksy could stay anonymous, but he could have every single piece of art that is done by this artist is all held by one wallet. And it's guaranteed that, if someone tries to copy this, well, that's just a control copy paste, right? And so, yeah.
No, listen, we're hitting 10:15
Yeah.
and and maybe 11:15 on your time, I think. But you know, I want to be courteous of your time and you know, thank you so much. We certainly look forward to having you guys join us again. Every time we've spoken to you and your team, it's been a phenomenal conversation. So I want to thank you so much, both from the HIA, our two committees, and you know, welcome, you know, hearing from you guys again. So thank you so much. Thanks everybody for joining. We'll certainly have Sean back again. This was fantastic. I can't say anything else. Thank you so much.
Thank you, guys.
Thank you, Sean. Thanks for sharing all this knowledge.
It's been an absolute pleasure, guys. Thank you so much, and looking forward to chatting again.
What a great job. Thank you.
Thank you, everybody.
Thank you, Sean.
Thanks, everybody.
Take care.